On February 1, 2025, President Donald Trump announced significant tariffs targeting key U.S. trading partners. The executive orders imposed a 25% tariff on all imports from Canada and Mexico, with a reduced 10% tariff specifically on Canadian energy products. Additionally, a 10% tariff was levied on imports from China. These measures were set to take effect on February 4, 2025. The immediate market response was turbulent. Cryptocurrencies experienced sharp declines. Bitcoin fell below $100,000, reaching a 3-week low, while Ethereum and XRP also saw significant drops. Traditional financial markets were not spared. The S&P 500 and Dow Jones Industrial Average both recorded losses exceeding 2% in early trading. In response to the U.S. tariffs, Canada announced retaliatory measures, including a 25% tariff on $155 billion worth of American goods. Mexico also declared its intention to implement counter-tariffs, targeting U.S. products such as pork, cheese, and produce. The rationale behind the tariffs, as stated by President Trump, was to address issues of illegal immigration and drug trafficking, particularly fentanyl entering the U.S. He acknowledged that these tariffs might cause some pain for Americans, but emphasized their necessity for national security. Analysts warn that these tariffs could lead to increased consumer prices and potential slowdowns in economic growth. The situation remains fluid, with ongoing discussions between the involved nations to mitigate the economic impact and explore possible resolutions. Trump's tariffs signaled a cooling off in international trade, triggering capital flight from risk assets like cryptocurrencies. Historically, Bitcoin has shown high correlation with global liquidity cycles. When money supply tightens, crypto suffers. According to the Federal Reserve, the M2 money supply contracted by 3.6% in 2023, marking one of the steepest declines in recent history. Crypto markets, already vulnerable to regulatory scrutiny, felt the pinch as liquidity dried up. The impact on global trade was severe. The World Bank estimated that tariff escalations in 2018-2019 led to a 1.4% reduction in global trade volume. A similar scenario played out with Trump's renewed tariff threats in 2024, with projections of a 1.5% decline. Historically, Bitcoin has shown a 7% decline for every 1% drop in global trade, aligning with a 10% dip in BTC prices in the wake of tariff announcements. The exodus of institutional investors from emerging markets further amplified crypto's decline, as capital shifted toward traditional safe havens like U.S. Treasuries and gold. Unlike equities, where institutional players dominate with long-term strategies, crypto is a hotbed for leverage. Data from Glassnode indicated that just before the market downturn, Bitcoin's estimated leverage ratio spiked to 0.27, its highest in 3 months. When Bitcoin started slipping, cascading liquidations followed, wiping out over $1.5 billion in crypto positions within 48 hours. Bitcoin's open interest on major exchanges like Binance and Bybit collapsed by 23%, signaling a mass exit from leveraged bets. This high exposure exacerbated the sell-off. Crypto exchanges witnessed a surge in forced liquidations, with nearly $500 million wiped out in a single day, per CoinGlass data. The domino effect triggered broader declines across altcoins, reinforcing the volatility that characterizes the crypto sector. China's response to Trump's tariffs was swift, including threats to restrict exports of rare earth metals, critical for semiconductor and mining hardware production. The impact on crypto mining was immediate. Bitcoin's hash rate plunged by 9% within a day, reflecting the strain on mining operations as hardware costs surged. Mining profitability dropped by 12% as a result, with energy-intensive operations in China facing increased costs. Publicly traded mining firms took a hit. Stocks of Riot Platforms and Marathon Digital plunged 18% in a single trading session, while smaller mining operations began exploring alternative jurisdictions. Kazakhstan, which already accounted for 13% of global hash power, saw a further 2% increase as Chinese miners sought alternative locations. The geopolitical uncertainty added another layer of instability to an already fragile crypto market. Institutional investors who had gradually increased exposure to crypto panicked in response to tariff-driven uncertainty. Bitcoin ETFs saw a staggering $1.3 billion in outflows in a week, reflecting the shift in sentiment. MicroStrategy's Bitcoin-heavy stock, MSTR, plummeted by 19%, while Coinbase shares dropped by 12%. Tesla, which still holds Bitcoin on its balance sheet, saw its stock price slip 7% as crypto exposure became a liability rather than an asset. The sell-off erased weeks of crypto's gradual recovery, underscoring the fragility of digital assets in a tightening macroeconomic environment. While crypto proponents argue for its independence from traditional markets, events like these reinforce its vulnerability to global economic shifts, trade tensions, and liquidity crises. The takeaway? Crypto remains a high-risk asset, deeply intertwined with macroeconomic forces and susceptible to geopolitical volatility. Donald Trump's stance on cryptocurrency has been anything but consistent. In 2024, he actively courted pro-Bitcoin voters, positioning himself as a supporter of financial innovation. However, his newly proposed trade war, which includes steep tariffs on Chinese goods, could set the stage for stricter financial regulations, including crypto oversight. The Securities and Exchange Commission, SEC, and the Commodity Futures Trading Commission, CFTC, have already hinted at potential new compliance measures to address financial risks in a post-tariff economy. Industry analysts estimate a 40% probability of fresh stablecoin regulations and a 35% likelihood of tighter crypto banking restrictions within the next 6 months. The regulatory uncertainty has led to increased volatility in the crypto markets, with Bitcoin's 30-day volatility index reaching 4.2%, the highest since mid-2023. China's aggressive push for digital yuan (ECNY) adoption could challenge the dominance of stablecoins like Tether, USDT, and USD Coin, USDC in Asia. The People's Bank of China, PBOC, has expanded digital yuan trials to over 260 million users, integrating it into cross-border trade agreements. A recent survey by Asia Crypto Trends found that 62% of Chinese traders fear potential USDT restrictions could significantly impact their trading strategies. Additionally, a report by Chainalysis indicated that over $150 billion in crypto transactions in East Asia rely on USDT, making any regulatory shifts a global concern. If China successfully incentivizes digital yuan use, it could accelerate a de-dollarization trend in digital finance, shifting liquidity away from US-backed stablecoins. The assumption that Bitcoin serves as an inflation hedge is under renewed scrutiny. Following the recent tariff announcements, gold prices climbed 4%, while Bitcoin dropped 14%, a stark contrast to its digital gold narrative. Historical data suggests that Bitcoin's inflation hedge claim remains largely unproven in times of economic distress. A Bloomberg intelligence report noted that Bitcoin's correlation to the S&P 500 remains at 0.72, reinforcing the argument that it behaves more like a high-risk tech stock than a safe haven asset. In contrast, gold's correlation to equities stands at just 0.07, affirming its resilience as a defensive investment. Meanwhile, institutional investors remain divided. BlackRock's latest fund reports indicate that institutional Bitcoin holdings have increased by 11% in Q1 2025, while other firms have trimmed exposure amid macroeconomic uncertainty. With regulatory headwinds, geopolitical shifts, and market volatility shaping the narrative, Bitcoin's status as a long-term store of value remains an open question for investors and policymakers alike. To fully understand the impact of Trump's tariffs on crypto, we need to zoom out and examine the broader economic context. Trump's tariffs are part of a broader trend of rising global protectionism, a movement that has intensified over the past decade. Since 2018, trade tensions between major economies, particularly the US and China, have led to escalating tariffs and retaliatory measures. The US-China trade war officially began when the Trump administration imposed tariffs on $34 billion worth of Chinese goods in July 2018, citing unfair trade practices and intellectual property theft. By 2019, tariffs had been placed on over $360 billion worth of Chinese imports, with Beijing responding with counter tariffs on US goods. The Biden administration has largely maintained these tariffs, signaling a sustained shift in US trade policy. Beyond China, the European Union, EU, has also been involved in trade disputes with the US, particularly over subsidies to industries like aerospace, Boeing versus Airbus, and agriculture. In 2019, the World Trade Organization (WTO) ruled that both the US and the EU had provided illegal subsidies to their respective aerospace giants, leading to billions of dollars in tariffs imposed on each side. These disputes have contributed to an environment of uncertainty, particularly affecting volatile markets, including cryptocurrencies, which tend to suffer during periods of heightened economic unpredictability. The imposition of tariffs and broader trade restrictions has significantly disrupted global supply chains. The semiconductor industry, already strained by high demand and production bottlenecks, has been particularly impacted by U.S. sanctions on Chinese firms such as Huawei and Semiconductor Manufacturing International Corporation (SMIC). The automotive sector, which relies on complex global supply chains, has faced production delays and increased costs when car manufacturers in the U.S. experienced price hikes due to tariffs on steel and aluminum since 2018. According to a 2021 study by the Peterson Institute for International Economics, U.S. import tariffs increased the cost of affected goods by an average of 25%, ultimately being passed on to consumers. The inflationary pressures exacerbated by these trade policies contributed to rising costs across multiple sectors, further straining economic growth. Trade tensions often intertwine with geopolitical risks, adding another layer of uncertainty to global markets. The U.S.-China trade war has coincided with increased military tensions in the South China Sea and the Taiwan Strait. In 2022, China ramped up military exercises near Taiwan in response to high-profile visits by U.S. officials, heightening concerns over potential conflict. In Europe, the EU has struggled to maintain a unified stance on U.S. tariffs, with some member states pushing for aggressive countermeasures, while others prefer diplomatic resolutions. The lingering effects of Brexit have further complicated the EU's trade policies, as the UK has had to renegotiate numerous trade agreements independently. The rise of protectionism, exemplified by Trump-era tariffs and continued under subsequent administrations, has reshaped global trade dynamics. These measures have disrupted supply chains, increased inflationary pressures, and fueled geopolitical tensions, creating an unpredictable economic landscape. As trade policies continue to evolve, businesses and investors must navigate an increasingly fragmented global economy, where risk assets such as cryptocurrencies remain particularly vulnerable to policy shifts and economic uncertainty. Central banks play a crucial role in shaping the economic environment, and their policies have a direct impact on crypto markets. In response to rising inflation, central banks worldwide have been aggressively tightening monetary policy. This includes raising interest rates and reducing asset purchases to curb inflationary pressures. The U.S. Federal Reserve, for example, has implemented multiple rate hikes since March 2022, pushing the federal funds rate from near zero to over 5% by early 2024. Similarly, the European Central Bank (ECB) and the Bank of England have followed suit, with the ECB raising rates to a record high of 4% in September 2023. These measures are designed to reduce excess liquidity and slow down inflation, which reached 9.1% in the U.S. in June 2022, the highest in 4 decades. However, these aggressive rate hikes have tightened financial conditions, negatively impacting risk assets, including equities and cryptocurrencies. Bitcoin, often considered a hedge against inflation, saw a significant drop from its all-time high of nearly $69,000 in November 2021 to around $16,000 by late 2022 before partially recovering. Trade tensions frequently extend into currency markets, leading to competitive devaluations. The US dollar has strengthened significantly, with the dollar index DXY reaching a 2-decade high of over 114 in September 2022, making imports cheaper for the US, but putting pressure on emerging market economies with dollar-denominated debt. China, which has long faced accusations of currency manipulation, allowed the yuan to depreciate in 2023, with the exchange rate crossing the psychologically important 7.3 yuan per US dollar mark. This depreciation has fueled trade tensions, as a weaker yuan makes Chinese exports more competitive, drawing criticism from US policymakers. Additionally, Japan's yen fell to a 34-year low against the dollar, prompting government interventions to stabilize the currency. These currency dynamics have profound implications for crypto markets, especially stablecoins pegged to fiat currencies. A stronger dollar increases redemption pressure on dollar-backed stablecoins like USDT and USDC, while depreciation in other fiat currencies can boost local demand for crypto as an alternative store of value. As central banks continue adjusting policies, financial markets remain highly sensitive to macroeconomic shifts, making digital assets increasingly intertwined with global monetary trends. Despite the current turmoil, the long-term outlook for crypto remains uncertain but potentially promising. The cryptocurrency market is at a pivotal juncture, with both significant opportunities and notable risks shaping its future. Understanding these dynamics is crucial for investors, institutions, and policymakers alike. Several key factors could drive future growth in the crypto market. Institutional adoption. Despite market downturns, institutional interest remains strong. In 2023, BlackRock, the world's largest asset manager, filed for a Bitcoin spot ETF, signaling confidence in crypto's long-term potential. Similarly, major banks such as JP Morgan and Goldman Sachs continue exploring blockchain solutions and crypto custody services. Technological innovation. The crypto landscape is constantly evolving. The rise of Layer 2 scaling solutions like Optimism and Arbitrum is improving Ethereum's scalability, while Bitcoin's Taproot upgrade enhances privacy and efficiency. The decentralized finance (DeFi) market surpassed $50 billion in total value locked TVL in early 2024, demonstrating sustained growth. Meanwhile, NFTs and blockchain gaming continue to expand into mainstream industries. Regulatory clarity. While regulatory uncertainty has been a long-standing challenge, clearer frameworks are emerging. The European Union's Markets in Crypto Assets (MiCA) regulation, set for full implementation in 2024, aims to provide comprehensive oversight. In the US, the SEC's evolving stance on crypto assets, combined with growing bipartisan discussions on digital asset legislation, may foster a more stable environment for growth. However, significant risks could hinder crypto's trajectory. Regulatory crackdowns. Governments worldwide are tightening scrutiny. China banned crypto mining in 2021, and the SEC has increased enforcement actions against exchanges. India continues debating strict taxation and potential bans on private cryptocurrencies. Market volatility. Crypto markets remain highly volatile. Bitcoin dropped from its all-time high of nearly $69,000 in November 2021 to under $16,000 by late 2022, before rebounding above $40,000 in early 2024. These drastic price swings pose risks for retail and institutional investors alike. Security concerns. The crypto sector remains vulnerable to cyber threats. In 2022 alone, hackers stole over $3.8 billion from crypto projects, with DeFi protocols accounting for the majority of breaches. High-profile collapses, such as the FTX scandal, have further shaken investor confidence and emphasized the need for better security measures and transparency. As crypto continues to mature, balancing innovation with regulatory compliance and risk management will be key to its sustainable growth. The crypto market is currently navigating a perfect storm of economic, geopolitical, and regulatory challenges. Trump's tariffs have added fuel to the fire, triggering a sharp sell-off and raising questions about crypto's future. However, as with any storm, there is also the potential for calm and clarity on the horizon. By staying informed, avoiding excessive leverage, and keeping an eye on global trends, investors can navigate these turbulent waters and position themselves for long-term success. The coming weeks and months will be critical for the crypto market. Whether it emerges stronger or faces further challenges will depend on a complex interplay of factors, including global trade dynamics, central bank policies, and regulatory developments. In the meantime, the best course of action is to stay cautious, stay informed, and be prepared for whatever comes next. The crypto revolution is far from over, but the road ahead is likely to be anything but smooth. The future of crypto is still being written, and while the current chapter is fraught with challenges, the story is far from over. Stay tuned.